Welcome to Gold Bank Insider.
Good to be here.
We're looking at Ghana today. There's a real tension in the story coming out of the country right now.
There is. You've got this incredible performance on one side, but a huge policy question mark hanging over it on the other.
Right. The headline that grabs you is the record gold output for 2025, a new high.
A new high, absolutely. But almost in the same breath, everyone's attention is shifting to this potential policy change.
The royalty system.
Exactly. Moving from a fixed rate, which is predictable, to a sliding scale, which introduces a whole new level of uncertainty for operators.
And for anyone in the UK holding these stocks, this is, well, it's a fundamental change to the investment case.
It is. Ghana is a major global producer. You can't ignore it. So when they change the rules of the game, it forces everyone to go back to their spreadsheets and recalculate the risk.
So we have this strange picture. Production is booming, but the government wants a bigger piece of the pie, and they might make that happen, what, as soon as this month?
That's the timeline we're hearing. It's moving very quickly.
Okay, let's start with the good news then. The 2025 numbers. A record year.
It was. The total output for the country hit 6 million ounces.
6 million. That's a huge number. On the face of it, that suggests a sector that's firing on all cylinders.
It does, but you have to break that number down. It's not a simple story.
How so?
Well, if you look at the large-scale mines, the big listed companies that our listeners are likely invested in, they produce 2.9 million ounces.
So just under half the total.
Just under half. And the crucial part is that figure, 2.9 million, is basically flat compared to the year before.
So the big players, the corporate giants, they didn't really move the needle at all.
In aggregate, no. They essentially maintained their production levels. There was no big surge in output from them, despite, a very high gold price.
Okay, so if the corporates were flat, but the total number hit a record 6 million, the growth had to come from somewhere else.
And it did. The entire increase, the whole story of 2025's record, came from the artisanal and small-scale mining sector, the ASM.
What did their numbers look like?
Their output climbed to about 3.1 million ounces.
Wait, so the small-scale sector actually produced more than the large publicly traded companies?
They did. It's a really stark divergence. Tells you they're two very different stories playing out in the same country.
Why? What drove that massive jump in the ASM sector?
Well, the first and most obvious driver is the gold price.
Right.
When prices are this high, the economics for these smaller, more agile operators just become incredibly attractive. They can mobilize fast. They can work deposits that a big company wouldn't even look at.
But is it just price?
No, that's the other part of the story. The data also suggests that government reforms have had an effect.
Reforms to what, exactly?
To how that gold gets into the formal system. There have been efforts to create official channels for ASM producers to sell their gold.
I see. So it might not just be that they're digging more gold out of the ground.
It's also that more of the gold they're digging is being officially counted. It's not disappearing into informal or illicit markets. It's entering the official statistics.
So a combination of high prices and better regulation.
That seems to be the formula that created this 2025 record.
Okay, so that's the backdrop. A record year driven by the small guys. But now this success has maybe created a new problem. The 2026 forecast of 6.5 million ounces is looking shaky.
It's very much at risk, and that risk is tied directly to this proposed change in the royalty system.
Let's get into the mechanics of that. What are companies paying now, and what could they be paying in the future?
Right now, it's simple. There's a fixed royalty rate. It's predictable. A company knows that, say, X% of their revenue goes to the government. Full stop.
And the proposal?
The proposal scraps that. It brings in a variable sliding scale that ranges from 5% all the way up to 12%.
And what makes it slide?
The gold price. It's pegged directly to the market.
So if gold is trading at, say, $1,800, you pay one rate, but if it jumps to $2,300?
Your royalty rate automatically goes up. The government's take gets bigger as your revenue gets bigger. In a high-price environment, you could be paying that top rate of 12%.
12% of revenue. Not profit. Revenue.
That's the critical distinction. It comes right off the top line. The government's logic is that they want a larger share of what they see as windfall profits.
But for the producer, it just feels like a cap on your upside.
It is. It makes it much harder to benefit from a strong gold market. And the timing on this is, as we said, potentially imminent.
So let's talk about what that does to a company's planning. When you plug a potential 12% royalty into your financial model for a mine, what happens?
Well, the first thing that happens is your cash flow projections drop. It's a direct hit. And that means your all-in sustaining cost, the real cost to produce an ounce of gold, goes up.
And if your costs go up, your appetite for new investment must go down.
It has to. Every company has an internal hurdle rate for new projects, a required rate of return. If a higher tax pushes the potential return on a new mine or an expansion below that rate,
You just don't build it.
you don't build it. The board won't approve the capital. And that's how a policy change today stops production growth 2, 3, 5 years down the line.
Which puts that 6.5 million ounce target for 2026 in serious jeopardy.
It does. That target assumes investment continues. This policy puts a question mark over that assumption.
Okay, so with that framework in mind, let's divide the field. Let's talk about the winners and losers here. Starting with the winners, it seems the ASM sector is, for now, in a pretty good spot.
They're the standout winners from 2025, no question. They delivered 3.1 million ounces of growth.
And their business model is just different, isn't it? They're not making 10-year investment plans based on complex feasibility studies.
Not in the same way. They are incredibly price responsive. They operate with a different capital structure. They can react to market conditions almost immediately.
So as long as the gold price stays strong,
Their output is likely to remain very robust. The 2025 numbers prove that they can really surprise to the upside when the incentives are there. They're providing the growth that the big formal miners aren't.
right. So now let's turn to those formal miners. We said in aggregate they were flat, but that must hide some individual stories. Are there any corporate winners?
There are. Yeah. You have to look for the companies that are in a specific phase of their life cycle, the ones that are already ramping up new production.
They've already spent the money, basically.
Exactly. The big investment decision was made years ago. A prime example is Shandong mining.
With the Cardinal Namdini project.
Yes, Cardinal Namdini is well into its ramp-up. The mine is built. They're just focused on increasing the throughput. So they are adding new ounces to the national total, almost regardless of this policy debate.
They've got momentum.
They do. And Newmont is in a very similar boat with their Ahafo North project.
Another big project coming online.
Yes, another major asset that is in the execution phase.
So Shandong and Newmont are the offsets. If other mines are declining, these two are providing the new supply that keeps the total for the large-scale sector from falling.
That's a good way to put it. They are winning through volume growth that was locked in years ago.
There's a third name on the winners list, but for a different reason. AngloGold Ashanti.
Right. AngloGold isn't really about new growth in this story. It's about resilience.
And their main asset there is Obuasi.
The Obuasi mine, yes. It's a huge, long-life asset. And the key here is that AngloGold isn't currently facing a nail-biting go or no-go decision on a major new expansion in Ghana.
So they're not caught in this trap of trying to justify new capital spending under a tougher tax regime.
Precisely. They have a steady world-class operation. And a climate of uncertainty, being the steady hand, is a form of winning. They're insulated from that immediate decision-making pressure that some of their peers are feeling.
Which is the perfect transition to the losers.
Yeah.
The companies that are feeling that pressure. And the name that comes up again and again is Perseus Mining.
Perseus is the textbook example of a company caught by this. They're evaluating the Edikan expansion.
This is a project to extend the mine's life, right?
It is. But extending the life of a mine isn't free. It requires a lot of upfront capital investment. You have to develop new areas of the pit, build infrastructure.
And you do all that based on a financial model that tells you it'll be profitable.
Correct. And this new royalty scale completely changes the math in that model.
How badly?
Well, the analysis suggests that if the royalty goes up towards that 12% mark, it could push the entire Edikan expansion into what we'd call uneconomic territory.
So it either loses money or just doesn't make enough of a return to be worth the risk and the capital.
Exactly that. The project's return would likely fall below their minimum threshold, and the board would have no choice but to shelve it.
And that's a direct loss of future ounces for Ghana.
A direct loss. That's the mechanism in action. Higher taxes leading to canceled investment.
Another major facing some headwinds is Gold Fields.
Yes, Gold Fields has a different sort of problem, a geological one, at their Damang mine.
Declining grades.
Declining grades. They're digging up rock that has less gold in it per ton than it used to.
Which means your cost per ounce automatically goes up.
It has to. You're moving the same amount of rock, burning the same amount of diesel, but getting less of the valuable metal at the end of it. So their margins are already getting squeezed by the geology itself.
And now the government is proposing a fiscal squeeze on top of that.
It's a double whammy. You have rising operational costs meeting a higher tax on your revenue. That's a recipe for severe margin compression.
And unlike Newmont or Shandong, they don't have a big new project in Ghana coming online to offset that pressure at Damang.
No, they're managing a mature asset. And that makes a company extremely sensitive to any sort of tax hike.
Finally, there's a group of smaller operators, Adamas Resources and Asante Gold are mentioned.
The concern for them is, quite simply, their ability to absorb this. They're seen as being hit particularly hard by the proposal.
Is that a balance sheet issue? A lack of diversification?
It's both. They don't have a big global portfolio of mines to spread the risk. Their operations in Ghana are central to their business, and they often operate on tighter margins than the supermajors.
So a 12% royalty isn't just an inconvenience, it could be a real threat to their cash flow.
It could consume a huge portion of it. They are, you could say, the most exposed and the most vulnerable to this change.
Okay, so let's zoom out. For our listener in the UK, maybe holding a gold ETF or shares in one of these companies, what are the bigger market implications here?
There are two levels to it. First is the impact on the gold price itself.
Okay.
Look at the Perseus example. If that expansion gets canceled and similar projects at other mines get put on hold, then the future global supply of gold is going to be lower than we all thought.
The supply growth gets capped.
It does. And from a purely supply-demand perspective, a tighter supply outlook is generally supportive for the commodity price at the margin.
So this could ironically be good for the gold price.
It could. But that brings us to the second level, the equities,
Mm-hmm.
the miners themselves.
And that's a different story.
A completely different story. For the companies, what matters is the risk premium. Investors hate policy uncertainty.
Right.
If Ghana gets a reputation as a place where the tax rules can change suddenly and dramatically, investors will demand a higher return for taking on that risk. The cost of capital for any company operating there goes up.
So the market will apply a discount to the value of their shares.
You'd expect it to, yes. A gold mine in a stable, predictable jurisdiction is simply worth more on paper than the exact same mine in a jurisdiction that's perceived as risky.
So the takeaway for an investor might be to be constructive on gold, the metal, but maybe more cautious on the specific miners with heavy Ghana exposure.
That would be a prudent way to look at it, yes. The risk is concentrated in the company's profit margins.
All right, to sum it up then, 2025 was a record year for volume, but it was driven almost entirely by the small-scale artisanal sector.
While the corporate giants largely stood still.
And now 2026 is shaping up to be defined by this policy battle over the new 5 to 12% sliding royalty.
That's the variable that will dictate capital flows for the next few years.
We've identified the winners, the agile ASM sector, and the big companies like Newmont and Shandong, who are already in the middle of a ramp-up.
And the more challenged players are those like Perseus, who need to make a fresh investment decision, or Gold Fields, who are battling geology as well as fiscal pressure.
So I'll leave you with the final word. What's the key thought our listeners should be mulling over?
The thing to watch is whether this becomes a template. We saw in 2025 how quickly supply can respond to high prices. Now we're watching the policy respond to those same high prices.
The contagion risk you mentioned earlier.
Exactly. If Ghana manages to implement this sliding scale, and they successfully capture more revenue without completely killing investment, do their neighbors take notice?
Does this become the new playbook for West Africa?
That's the big question. If other governments in the region decide they also want a larger share of high-price revenues, it would fundamentally reshape the investment case for one of the world's most important gold-producing regions. That's the trend to watch.
A lot to think about. That's the situation as it stands. Thanks for listening to Gold Bank Insider.